Ashwini Agarwal joins us now. Let's take our conversation forward. Ashwini, will the bad get worse before it gets better, or we are in a buying zone, little bit of here and there, but you will stick your neck out and say, I am a buyer in this market?
So I think there is extreme negativity in the marketplace. If you look at some of the price action that is happening on the back of earnings misses of a small magnitude, it clearly tells us that there is a very, very high level of nervousness, and there is very high degree of negative sentiment. And if history is anything to go by, these are the kind of markets where you should be buying and you should be an investor. Yes, I feel that we are in a territory where if you were to take a 1 to 2 year outlook, you'd make a lot of money. There are stocks which are trading at very, very compelling valuations. Faith doesn't exist anymore, and this is really the time one should be investing. I don't know if things are going to get a lot worse before they get better. That's a very difficult question to answer. But I would definitely say that the pessimism is extreme. If you look at the newspaper headlines, the government seems to be recognizing that it needs to do something. I don't know what they will do, what they will come up with in terms of a policy response. But my sense is that things are at an extreme in terms of a negative sentiment.
Ashwini, that's one thing on whether to buy and not to buy. And the bigger concern is what exactly to buy. So what is it that would you buy? Would you buy the beaten down consumption theme, or, a large part of the market which has been beaten down in this recent sell-off? Or would you stick by with the leaders? You'll say that, I know that these have been outliers even in the downfall. Cases in point being, Bata, paints companies, for that matter, some of the other names from within pharma which have stood out, or for that matter, some of the private corporate banking names as well. Would you stick by with the safe bets?
So, it's not a single answer. Unfortunately, it's going to be a little bit of both. In the sense that if you look at the private banks, if you look at some of the pharma names, they are still kind of looking attractive from a medium-term perspective, and one would buy them. I mean, pharma especially is at multi-year lows, barely off the highs, barely off the lows that most pharma stocks have recently made. Some of them are trading at multi-year lows. So they look quite interesting in terms of the frontliners, but the frontliner consumer names look fairly expensive to me, where I would prefer to go for some of the consumer discretionary names that have corrected significantly. So it has to be a little bit of both. Some of the frontliners for the sake of liquidity and safety, as well as the fact that earnings prospects are improving at the margin for them. And on the other hand, I would seek value where there are extreme price corrections, where business models are robust, balance sheets are fine. There might be a temporary hiccup to earnings. Consumer environment is quite soggy at this point in time. So if you see some of these stocks selling off, these are great opportunities to buy them. I mean, one of our biggest themes of investment is buying good businesses when they are going through a rough time, and that I think always pays off irrespective of where you might be in a cycle.
Mark, is Aurobindo Pharma between yesterday and today, and yesterday numbers went unnoticed. Earlier when Aurobindo Pharma used to come out with numbers, everybody used to flock in because big HNI investors, they normally would attend that con call. No one attended that con call. They have reduced the debt. Nobody talked about it because the market mood is such that wherever there is good news, markets are ignoring it. Wherever there is bad news, markets are punishing that stock. We are going through that. Rather, I don't want to use the word amusing, but we are going through this phase of the market where traders are hunting for bad news to pounce on those stocks and to beat it down. And that, I think, is visible in the way how some of the companies have reacted to the numbers and how some of the stocks are reacting to whatever corporate issues which have coming in. Ashwin, I'll tell you what I did yesterday. I opened up my mailbox and I looked at all the basic assumption mails which brokerages had shared in the month of January. And the theme of all the reports which came from CLSA, BofA, ML, Morgan Stanley was that 2019 will be a great recovery year for India. The world will slow down and India will blossom. Look at what are we staring at. The world is doing okay with the exception of Europe and China, and India is going through an acute slowdown. The basic assumptions for growth, earnings and P multiples have got challenged. A reset button has been pressed. Now, how does one figure out that where the reset will end?
Correct. So, I'd like to break up the problem into two parts. One is of the sentiment and fear, and the other is the fact that the economy is slowing down. If you come to the sentiment and fear, it is obviously led by the fact that we haven't seen any resolution to some of the extreme indebtedness in financial services companies. I mean, the names I'm talking about. We had expected some of this resolution to happen much earlier, but it hasn't happened. You saw the unfortunate event at CCD, and that kind of again has come as a rude reminder that a lot of the corporate debt problems are not fully understood or not fully out there, and that's I think hurting sentiment in a big way. We know that some of these financial services companies and banks are working very hard to resolve the problem, and the problem is resolvable. I mean, you apply some haircuts which are already reflected in the NAVs of the mutual funds that hold that paper, or the banks that have lent to these financial services companies, and if you actually apply that haircut and try and resolve the debt, there is a solution that's possible, and I believe it should come through in the near future. So, a lot of the negative sentiment of fear can get reduced or addressed if some of these resolutions take place. So my sense is that if we separate the fear from the reality and say that, look, the fear should normalize over the next 2 months, 3 months, I don't know how long it takes, but the slowing earnings is probably a reality that we have to contend with, then yes, of course, you have to live with the fact that earnings are going to be lower than what we had all imagined in January. But at the same time, there is excessive pessimism and excessive fear today, which will probably go away. So I think markets should be a little bit better by the end of the year compared to where they are today. Now, where have these earnings cuts come? So you mentioned that, when you saw your earnings estimates in January and you look at the situation today, things are very different. So obviously, in automobiles and discretionary spend, we have seen a significant slowdown. Some of it is coming from rural India. Some of it is also led by the fact that the NBFCs are unwilling or unable to lend. Now, the unwillingness or inability to lend should get addressed if the liquidity remains easy, which the RBI seems to have promised and has delivered on, and a couple of these resolutions start to take place, which will bring confidence back among the banks who lend to these NBFCs and the NBFCs themselves, that they have access to financing, that look, it's business as usual, we need to be careful, but let's start lending once again, which that lending activity has come to a complete standstill from how I understand it, driven by the fear, driven by the uncertainty that everyone's facing. And I think if the fear normalizes, you will start to see an improvement in things. But yes, you're right, we can't get away from the fact that the economy is growing slower than what we had expected at the start of the year. You will still see earnings growth in the financials from lower NPL provisions. So we are hoping that the SR Steel resolution will take place over the next month or two. Now that the matter is with the Supreme Court, let's see what comes out of there. So I think the NPL driven or the credit cost driven earnings growth will still get delivered. But on the consumer discretionary side, we'll probably have much softer numbers compared to where we were at the start of the year.
Ashwini, we both are diehard bulls, and we've lived an era where every time when investors have bought into bad news, they've participated, they've made money. But I only fear that is the regime changing?
Yeah.
I mean, are we in for pain, trade war, asset meltdown for next 2, 3, 5 years, which is that rather than investing, one should be in capital protection mode. I met a fund manager on Monday and he said, "Bhaiya, jo bhi hai, bacha lo. Abhi don't think of investing." I hope we are not there yet, but I'm seriously asking you a question based on cycles, patterns and the environment.
So let's go back to basic economics as to what is a recession and what causes a recession. An economic recession occurs when there is fear about the future, fear about uncertainty, and everybody does exactly what this fund manager told you on Monday, that jo hai usse bacha lo, put it in the banks, put it in gold, or put it under your mattress, because we don't know what tomorrow will bring. Obviously, in the equity capital market, that sentiment is the prevalent mood as of the last, I would say, several weeks now. If there is no policy response along the lines that I had outlined earlier in my conversation, if there is no resolution to some of the extreme stress with a few lenders, NBFCs and banks, if there is no new capital provided to the PSUs which can enable them to lend again, if there is no thinking on part of the government what it needs to do to provide a policy response to the economic slowdown that we are witnessing, can we get into a recession? Yes, it is possible. Those fears are not entirely unfounded, but at the same time, we have a lot of ifs, and everything has to go wrong for that terrible outcome to come through. One of the issues that, of course, India is facing is that the external environment, which is the world outside India, is not in a great shape. So we can't expect any tailwinds from the global economic system. So whatever has to be done internally. But at the same time, internally things are not bad. We might have fiscal which is slightly on the higher side if you consolidate all the off-balance sheet amounts and so on and so forth, but inflation is under control. We have plenty of reserves. The oil price is is subdued, and the outlook there is reasonably benign. There are plenty of policy options with the government. It can do a lot of things to address the situation. It can recapitalize the banks, it can attract more foreign capital, it can put out a couple of PSUs, large ones, for strategic sale, which will give it both the money and provide hope to the holders of PSU stocks that real value in these names can be realized. A lot of stuff can be done. So depends on what we want to assume. If you assume that nobody will do anything, yes, then what you outline is correct. But if we assume that no, the government is now cognizant that something hasn't quite worked the way it wanted to, and some tweaks are required and some stuff needs to be done, and if some of these things start to come through, then I think the fear factor will go away. The slowing growth will take some time to recover, I agree with that, but the fear factor which is prevalent today, that should go away if some of these things come through.
The niggling factor, Ashwini, is this entire FPI pullout to the tune of about $2 billion ever since the surcharge was slapped in the budget. Even though while we understand that the finance minister today itself is meeting the FPI fraternity and perhaps a rollback is in the works, we also understand that a comfort package, maybe some tampering to LTCG also is in the works, but who knows? But how badly is the sentiment damaged?
So stability of taxes and a business-friendly tax regime is essential to both compliance and to encourage investments. And unfortunately, the current administration or the previous administration has used every trick in the book to impose more taxes rather than rationalize the taxes and think about what it wants investors to do in India and how it wants investors to respond. In January 2018, we imposed the long-term capital gains tax. We saw the consequences of that. This year, we imposed surcharges on all income above a certain threshold, which unfortunately has brought into the net several foreign portfolio investors as well as domestic alternative investment funds. To my mind, it is a situation where all investors want certain stability in the tax regime. When you go into a country or you go into an investment, you want certain assurance that what we are assuming as a taxable income or what we are assuming as the tax rate applicable to the income you hope to generate will remain stable. And if that goalpost keeps moving, it becomes very difficult and it becomes very disheartening. Look at corporate income. You get charged at you pay the corporate income tax rate, then you pay dividend distribution income, tax on dividend distribution, and then in the hands of the investors, you again pay a dividend tax in excess of 10 lakhs of rupees of dividend income plus the surcharge on that. So effectively, you're talking about something like 58-60% tax effectively on pre-tax corporate income. I mean, how is that reasonable? And to my mind, a problem of compliance arises from the fact that you have multiple levels of taxation, layers of taxation on the same income, and that defeats the very purpose of hoping for higher compliance. So obviously, while the tax hit is not large, it has soured the mood to some degree. And I'm hoping that the government will do the right thing. I'm optimistic. So let's see what comes out of this.
Do you think a rollback, Ashwini, can change sentiment, or do you think it's a final goodbye that the FPI fraternity has completely bid adieu to Indian equities?
No. I think we are overreacting here. I mean, think about it. I mean, foreign investors own more than $400 billion of assets in India. They've sold $2 billion worth of assets, which is a very, very small number. Most investors who invest in India continue to like the long-term growth prospects that the country offers and will remain engaged with India. Obviously, as the taxes go up, your expected returns come down. So to that degree, your allocations reflect what your expected returns are on a post-tax basis. So that is a natural reaction. But to say that FIs are voting with their feet and all of them will go away, I think it just that's not real. That again reflects the kind of fear that all of us are suffering from at this point in time.
To wrap it up, what has been your activity? Have you added new sectors? Have you bought stocks which you earlier wanted to buy and now are they because they are available lower? Or you just buying the same old stocks and you just adding a bit more?
So we are doing a few things. Unfortunately, I'm not at liberty to speak about what we are doing. But earlier in my conversation, I highlighted that it's a little bit of all three, in the sense that we are adding to some of the frontline names that we continue to like, where we think the opportunity to make money is there in the long term. At the same time, we are adding to names that are beaten down, where we believe that there is excessive pessimism, valuations are extremely attractive, balance sheets are fine, cash flows are okay, there's a temporary blip in earnings, or there is a temporary issue that the street is worried about. If we feel comfortable enough to go in there, we are going in there. So it's a little bit of all of these things.
Ashwini, just one more follow-up question. Whereas we are excessively focusing on FIS selling, and it's less than $3 billion when I looked at the aggregate number for July and August put together, the SIP number in the same period or the DIF figure in that same period is about $2 billion. So there is a net gap at institutional level of $1 billion.
That's right.
And yet markets have collapsed. Why is that?
That's right. Well, markets have collapsed, like I mentioned, because of two reasons. One, that the economy is growing a lot slower than what one was looking at even 3 months ago. If you look at the auto sales data, that is self-explanatory. So that is, of course, getting reflected in the marketplace. And I think post the budget, there was a huge despondency with the investor community because of higher tax rates applied to income above a certain threshold, because of the surcharges applied, and because of the realization that moderate taxes in the long run, moderate and stable taxes, which is the bedrock of any well-functioning marketplace, is something that is not assured in this country. So I think the mood soured significantly. On top of that, we've not had a resolution to any of the stressed NBFCs/banks that we have been expecting for some time. There have been delays. One realizes that the intent to resolve is very much there, but there are regulatory wrinkles that need to be sorted out. That's taken time, so that's not helped. And last but not the least, I mean, while the liquidity in the interbank system has come through, it is still not flowing to the NBFCs, which is large part of the lending market. So, all these things have come together, and that has soured the mood considerably. So I think while FII outflows is an issue, and I think it is reasonable for all investors, domestic or overseas, to expect a moderate and a stable tax regime, and that is what I hope the government will deliver. I think the FII selling is modest, to say the least, and I don't believe that people are looking to exit en masse from India. I don't think that's the narrative at all.
To hear that, okay, Ashwini, thanks so much for taking the time out and speaking with us today.
You're most welcome.